Hello, today I will be talking about how I got an APV of 1,624.01 by playing the capital budgeting simulation. So there were 27 separate proposals over a 5-year period that we all had to choose from. And the 3 big numbers I focused on were the NPV, and usually the higher the NPV, the more likely it was for me to choose it unless I was expanding a project. The payback period, I tried to have it paid back in 5 years or less, just so it wouldn't put me over in budgeting. And I also looked at the internal rate of return, and I wanted that to be higher than the anticipated one. So the RRR was to be higher than the IRR. After I chose the first section, like the first year's projects, I looked at the revenues and the net incomes, and I proceeded to do that for each year. The replacement investments, the expansion investments, and the investments in mutually exclusive projects, the interdependent projects, and project with growth options, I decided that I wanted to focus on new projects, but I also wanted to improve the ones that the company had either already started or the projects that I had picked, and I decided to expand a lot of those because I feel that for a company to succeed successfully, succeed, they have to create new customers but also maintain the ones they already have. The revenue for 2009 was $245.75, and now it's currently $373.31. The operating income was $22.60, and now it's $44.21, which means I doubled the operating income. And then the net income was $13.56, and now it's $26.53. The revenue for retail division was the most, and I think that that's good because there are sales associates and the customers come into the stores to get the product, and I think that retail should be the highest and then production should closely follow behind, which production had 173.84 and then licensing had 76.87, but in operating profit, licensing had the most because there were a lot of projects that solely relied on licensing that I decided to choose. And then for the total assets, production and retail go hand in hand with that. As you can see, the actual and the forecasted, the actual surpassed the forecast every single time, and that was my goal at the end product. In the income statement and balance statement, the net sales for 2014 are $373.31, and then it shows the next 10 years. So in 2024, it'll be $574.21. The net income for 2014 will be $26.53, and in 10 years it'll be $49.39. The assets for 2014, the current assets are $143.30. In 10 years, they'll be $220.16. And then the total assets will be $253.54. And in 10 years, it'll be $379.04. And then the liabilities increased, not drastically, which is good, but they did increase more than I would like them to. Right now it's 60.16, and in 10 years it'll be 97.31, and that's only because of the long-term debt. The shareholders' equity will get higher, and then also taxes. increase as the years go on. With the NPV and the IRR, if you look at the project details, I decided to get the NPVs of the higher ones, and then I looked at the risk factor. For instance, the toddler doll accessory line, the risk factor is low, and I changed the production rate of the project discount rate to be 4.00 because I read in the foreground reading that this company wanted to focus on getting more toddler customers and tween customers, so I tended to choose tween and toddler. For instance, this is the accessory line, so of course it will be toddlers, and I gave them a 4.0 project discount only because I didn't know how it would react to the company, and the low risk helped. But I also noticed that all these projects started with a 7.85% discount, and I changed them to some considerably lower only because of the risk, the NPV, and the IRR. As you can see, in 2015 the project cost is 0, and that's very good. And then for Match My Doll, this one focused more on the tweens, so I gave it a bit of a lower discount. Even though the risk was high, I didn't know if solely focusing on tweens was a good idea for the company or not, so I did experiment with the project discount rate. Then whenever Match My Doll was successful, I decided 3 years after, I decided to expand that, and that was a really good deal for the company, as you can see in project updates later. Then I did choose the supplier software system at a 3.50 project discount rate, only because this has both toddler and tween products, and I had focused on a lot of the toddler and tween products. The doll houses with miniature dolls would be a toddler product. The retail store expansion in Northeast I picked right away because I wanted to get our retail stores out there. I picked that the very first year. Then I did expand to England, and I had a mail order catalog business to Asia. I chose bookstore, cafe, writers club, virtual doll community, and a lot of the other tween and toddlers focus segments. I did do resource allocation, where I decided to pick the ones that maybe weren't as popular and some that didn't have such a high NPV. For instance, the ADI supplier software, that had a very low NPV, and it still has a very low NPV, but it would help my products in the long run, so I chose it. And the cash flow statement talks about how the net change in debt increases, but it doesn't do it as much. It decreases, then it increases, then it increases by 2 to 3. And then the depreciation does have 4 more in 10 years, so it's not too bad. And again, the 5-year cumulative, the levered enterprise, the present value, it's pretty consistent. It's not too dramatic of an increase, which is what I was going for at the beginning when I started this simulation. Once again, I did focus on the NPV. I wanted the RRR to be higher than the IRR, which just means that it would be higher than I and the company anticipated. And then I did choose the products that you could pay back in 5 years or less. There were a lot of different risks that I took. I took the low, the high, and the medium ones only because I never knew what it would quite do. In any company, you have to take some risks, so high risks are good because they can give you high reward. In this case, it did for me. And low risks are good because they're safe bets. So again, I didn't give them drastic discounts, which is good. And the medium ones are kind of just in the middle, so you know that it's a 50% chance of working. And in my project updates, in 2009, I started with the new doll film, the DVD, the Match My Doll clothing line, the toddler doll accessory line, and I did expand that retail store in Northeast. I focused on toddlers right away, and then I also focused on more entertainment. So for instance, a clothing line and the film. And the clothing line did really good after a celebrity's daughter were photographed wearing items from the line, which publicity is good, so that really, really helped the company. In 2010, I just solely expanded the mail order catalog business to Asia. There was a project that was Dolls of the World, which I could have included, but I decided not to. So as you can see, it says local managers are now looking for ways to speed up penetration in Japan and China, and it did 3 times higher than projected. So if I did have the Dolls of the World, that would have gone really well with that. In 2011, I focused on the acquisition of children's magazine, the doll video game, and the tween book series to really focus on that tween base. In 2012, I decided to expand the Match My Doll clothing line because it had done so incredibly well those past 3 years. And then in 2013, which was the last year of the simulation, I tried to focus on a bit of everything. So I helped the software system. I got the doll houses with miniature dolls. I did expand to England, and it was somewhat lower only because I feel that if I did once again invest in the Dolls of the World, it would have gone higher. The virtual doll community, the bookstore, cafe, and writers club, and the toddler music CD series to make sure that everything they wanted in the foreground reading of this company, I really focused on in the last year. Capital budgeting rules significantly influence the company performance and market position because you can't choose all the projects you want. The very first time we did this with the unlimited budget, it was really easy for us to say, oh, we want this, this, and this, and this, and this, and then at the end have all the projects because it was an unlimited budget. But this budget being so little, you had to really focus on those 3 numbers. Again, you had to make sure that the NPV was good and that the payback rate wasn't too absurdly high. Like, you didn't want it to be paid back in 10 years. You wanted to get your profit sooner rather than later. And then the RRR and the IRR, you just wanted that above because you always want to do more than's forecasted. So in my dashboard, going back to that, I did more than was forecasted. Actual was greater, and that's something you really want to focus on. And that is how I got a APV of 1,624.01 by focusing more on new projects and old projects. The first time I did this, I solely focused on just creating the new ones, and then I kind of realized, oh, you want to improve the ones you have and you want to expand certain things because customers might like those. So I focused on both of them. I focused on the target market that the foreground reading really talked about. And then I also changed those discounts to not be the exact same like when it started out. Thank you.